Did you lose all your money in the stock market this year? Did you blow up your account? Can you not even look at your account balance without swearing at yourself or the market gods? Why did you do that? Yeah, I know 2022 has been a tough trading year, probably the worst since 2008 in my opinion, but that's really no excuse. You know, every big loss begins as a small loss. It might have even began as a profit. So if you lost a bunch of money in the market, and I know many investors did, I am truly sorry. I blew up my account twice, and I know how painful that is emotionally and financially. But sending you my condolences, it's not going to bring that money back. But here's what I can do for you. Let me explain to you the 5 reasons that you ended up with huge losses in your account this year. And I'm not telling you this to embarrass you or to make you feel bad about yourself. I'm teaching you these 5 reasons so that you can look at the man in the mirror, channel your inner Michael Jackson, right? And look at the man in the mirror or woman in the mirror and make a change, make an investing change in your strategy so that you don't do these things again. So I suspect you have made at least one of these huge mistakes, maybe all 5. The first one is poor risk control or no risk control. Listen, you've got to control your risk. You've got to think risk first. You've got to set sell stops, and you've got to prevent those small losses from becoming big losses. The first way you can do it is by a percentage basis. Personally, I set a sell stop between 5 to 10% depending on the chart and support levels, and I never let a stock, I never get underwater more than 10% on a stock, unless of course there's an unexpected gap down, which, as you know, you can't always help, and that's for handling gap downs is for a different episode. But if the market is going to kill me, it's going to do it by paper cuts. I can take a lot of 5 to 10% losses and my account balance is still going to be okay. Another way you can control risk is via dollar amount. As soon as you buy that stock, or even before you buy that stock, ask yourself, how much money am I comfortable losing? We love to think about, you know, this stock doubling or tripling or the thousands of dollars we're going to make. But figure out how much money you're willing to lose. Maybe it's $100, maybe $500, maybe $1,000. Another way you can control risk is by setting your stop so that when it triggers that dollar amount, then you're out, right? So that you never lose more than that dollar amount on a single trade. Third way you can control risk is via time. You think a stock's going to break out, or you bought what looked like a breakout, the stock squatted and pulled back into the pattern, then you can say, I'm going to give this stock 1 week to break out. And if it doesn't, then the train is not leaving the station at its allocated time. Something is wrong, and I'm getting out. Another thing you can do is you can finance risk. You can, for example, play a short-term move and say an oil stock or Pepsi or something, and make a 5 or 10% gain, and then sell that. Now you have a little cushion, right? You have a little profit, and now you can buy your speculative stock, your Rivian or your, I don't know, Palantir or something, and now instead of giving it your 10% stop, you can give it a 20% stop because you financed that extra 10% with the profit you made in the stock that you sold. But what you absolutely cannot do, no matter how smart you are, I'm talking to you, Cathie Wood, is buy and hold stocks without any sort of risk control. That is a recipe for disaster. And you may wake up one day and find yourself down 90% on stocks that are going to take years to recover from. So here's the second one, and that is bad entry point. You need to buy as close to pivot points and breakout points and pullback bounces as you possibly can. And that's beyond the scope of this video, although you'll find that I've talked about all of these things in some of my technical analysis videos. But what you need to do is learn how to have low risk, proper entry points, and not buy stocks that are overextended. Even the best stock can be a bad stock if you buy it when it's way overextended. A stock that's going up parabolically and in some sort of climax run, if you buy at that point, you're setting yourself up for a pullback. And then you're going to find yourself underwater. Or if you're using proper risk control, you're going to sell at your 10% loss, and then it's going to go back up because it's just going through a natural reaction. But you couldn't ride through that natural reaction because you had a bad entry point. So you have to have precise entry points. Do some study on technical analysis to learn about proper entry points. Now, if you have good entry points and you have good risk control and you're still losing lots of money, then your timing is almost certainly the cause. Your timing is off. It's poor market conditions. You're swimming upstream. If the general market is trending down day after day and you're going long on stocks, you're swimming up current, and it's going to be extremely hard to be successful, and probably you're going to lose money even if you're the best trader in the world. You need to have what Mark Minervini calls sit-out power. There's times to get really aggressive in the market. There's times to be methodical. And there's times to trade small or not at all and just sit it out. From September 6th to October 25th, this historically is the very worst time in the market. So you might consider exercising your sit-out power right now. So here's another one, and this is number 4. Maybe you're revenge trading. Maybe you took out a $1,000 position and it went down 90%. So instead, you feel like you got to get your money back. So now instead of putting on another $1,000 position or a $500 position, you buy $5,000 worth of a stock. And then that one goes down, and now you're really stuck, right? So now you got to get your revenge on Mr. Market, and now you buy a $10,000 block in the same stock or in something else, and then that one goes south, and exponentially your losses are getting bigger and bigger, which leads me to number 5. Maybe chances are you lost money due to a lack of progressive exposure. Let's use the gas pedal traffic metaphor. So you're driving down a busy street. There's all sorts of traffic congestion, cars pulling out in front of you, bicyclists, whatever. What do? You go really slow, right? And you barely step on the gas. You might even have to stop a few times. Then you get out onto the open freeway and there's very little traffic. Then what do? You step on the gas. Well, the same thing applies to investing. If you're getting stopped out often, then that's giving you feedback. That's telling you you need to slow down. If you're getting stopped out of your trades, then you need to stop or at least trade smaller. If you put on $3,000 trades and you got stopped out of all 3 of them, then your next few trades you should put on $500, right? Or maybe $250. And I'm just giving you, percent. Really, it's percentages. You can do 10,000 to 5,000 to 1,000. But the point is, don't gas it unless your stocks are doing well. When your stocks are breaking out and extending and going up 20% before the next base, that's when you gas it. That's when you start putting on big positions, not when you keep getting pummeled by the market, right? So that's trading progressively. And you don't just, let's say you have a stock that is doing really well. You don't just throw a bunch more money at it at any time. No, you wait for a proper entry point. Or with the next position, you increase the position. So you put $1,000 into a stock, it's doing well. Then you open up a second position, and this time your position is $2,000. Or when that original stock sets up and breaks out again, then you add another 1,000. Those are doing well. Then your next trades are 4,000. Oh, what's that? You got stopped out? You bump it down to 2,000. Bump it down to 1,000. Got stopped out on your last 3 trades? Then you stop. And you ask yourself, what am I doing wrong? Is it bad timing? Is it bad entry points? Am I not controlling my risk? Am I trying to get revenge on the market? Am I not progressively adding and subtracting exposure? All right, well, I hope that's been helpful for you. Like I said, if this does apply, take a look at yourself, like Michael Jackson says, and make a change. If you like the video, let me know if you're making any of these mistakes, or if maybe there's a mistake that I haven't thought of. I'd be interested in knowing in the comments. Okay, good luck, everybody. Take care.